Welcome to Yadnya Investment Academy. Last week, the government announced the launch of its second exchange-traded fund, Bharat 22, which will comprise of 22 government-run companies as well as few of its holdings under the specified undertaking of Unit Trust of India. And in this video, we're going to talk about the same. Let us first understand what is an ETF or an exchange-traded fund. ETF is just like an index fund, but the units of which are bought and sold on the stock exchange. In case of an index fund, the units of the index fund are bought and sold via the mutual fund. ETF, just like the index fund, also copies an index in terms of holdings, and hence the performance of these funds are similar to that of the index. ETFs are less risky as they are copying an index and have low fund management charges. As ETFs are bought and sold on the stock exchange, these involve brokerage charges and you need a demat account to do the same. So what would Bharat ETF be like? The government is going the ETF way to disinvest and meet its fiscal deficit target for the financial year 2017-18, which is 72,500 crores, out of which only 9,300 crores has been met till date. The ETF would be made of 22 stocks spanning 6 sectors. The sectors are energy, minerals, financials, industrials, utilities, and FMCG. ONGC, Indian Oil Corporation, and SBI, which are completely state-owned blue-chip stocks, would be included here, along with its partial stake in Axis Bank, L&T, and ITC. As you know, an index would not give equal weightage to all the stocks. So in this particular index, SBI would have 8.6% of weightage, ITC would have 15.2% of weightage, and L&T would have 17.1% of weightage, while NTPC, ONGC, and pare would have 5 to 9% of weightage in this index. This ETF would be managed by ICICI Prudential Asset Management Company, while the index would be provided by Asian Index. So why is the government going this way? Through direct disinvestment route, which the government has adopted earlier by selling big stakes in PSUs, the stocks take a beating in the market, and this process also attracts a lot of rage of employees working in the PSUs. The ETF would happen in tranches and would help the government to part small stakes in each of its holdings offered as a basket of 22 stocks. Secondly, it has tried and tested this ETF way through its first ETF, which was Central Public Sector Enterprise ETF, which was heavy on energy stocks, through which it collected 8,500 crores. Though the majority stocks are profitable and dividend paying, the government is bundling some stocks which would rather have been tough for it to disinvest. So the government is adopting a very effective and a smart way of disinvestment. And lastly, ETFs are very popular globally, and since Indian stock market is at an all-time high and when the world is wanting to invest here, Bharat 22 ETF could be a great entry point for them and also for individuals. And this way, the government could also attract great amount of dollars. So you might be thinking, what is in it for me? To attract investors, the government could offer stocks at a discount rate, which it did with CPSE ETF, which was its first ETF. So if the index looks good and the stocks too, you may want to own a slice. The long-term saving managers invest generally in ETFs globally. Employee Provident Fund Organization participated in the follow-on offering of CPSE ETF. So if this happens with Bharat 22, there is no reason why individual investors should stay away. So friends, hope the video has given you a fair idea about Bharat 22 ETF. Before we part, we want to let you know that Yadnya Investment Academy has come up with its first book, which is 108 questions on mutual funds and SIP. The book is available on Amazon and the link to buy the same is mentioned in the description of this video. So friends, thanks for watching this video. Watch this space for more such topics. Until then, happy investing.